Hey there, friend. Dominique Henderson here with DJH Capital Management. And if you're new here, keep in mind that this video is number 4 in a series about how to protect your wealth. So if you're just finding this video, then I'm going to highly recommend you go back and watch the previous 3. Now, in the last video, I left you with a question about how you can earn a reasonable, reliable rate of return without taking on unnecessary risk that causes you to not have to make any more money than you're currently making or save any more money than you're currently saving. That's a great question, huh? I think it is too. Well, before we get into how that happens exactly, I have to reveal to you how money actually works, how it flows. And there is no better way to learn how that happens, if you will, than to look at how banks operate. I promise that when you understand this, you will see how the definition of rate of return that you and I have been taught is totally different than what banks actually do. Again, if you like what you're seeing and learning, please consider subscribing to the channel, liking this video, leaving a comment, or sharing it with someone else. I'd really love if more people were to hear this message. Now, if you'd like to take a deeper dive on all of this with me in an immersive workshop experience that you can do all from the comfort of your own home, please consider joining me in the Protect Your Wealth Challenge. What's the Protect Your Wealth Challenge, Dominique? Well, it's where I'm going to show you all the secrets of how the wealthy have protected their income, built generational wealth, and avoided paying unnecessary taxes with a really simple tool. Okay? All you have to do is look down in the video description and click on the link in the section that says, join me for my next challenge. All right, let's get to this video. Now, before I show you how this is going to work, it's going to be over time. And I have to first explain how the money game works, because that is the second principle. You have to understand how the money game works. I'll be very transparent right now. I've been doing financial services for 20 plus years now. I'm a certified financial planner. I have a master's degree in securities analysis and portfolio management, which is just a really fancy term for saying a master's in finance. I have a bachelor's in finance. I've read books, look at the shelf behind you. And I didn't fully know how the money game worked until I dove deeper. So if you're feeling like, dude, I already know this stuff, Dominique, or, oh my gosh, I can't believe I didn't know this, whatever end of the spectrum you fall on, it's totally okay. Okay, we're no what's the saying, glass house, no stones. Okay, so what I first want to show you here is this concept that you may have seen before, maybe not, but I think it is a very appropriate way to kind of look at this. So here we go. You interact with the bank, which is, like I wrote in the blog, or the article that you read. They are the system. They are the profiteers, if you will, that use money. And actually, they do a lot of things. They do actually the opposite of what they tell us to do. They tell us to, bring our money to the bank, save it, and all the while they have money in motion. And that's what I'm about to show you right now. And then we're going to flip to one example, which is probably pretty humanly universal, which is purchasing cars. Because I know after you finish watching this, you're probably going to go, well, dude, I'm just going to pay cash for everything. And I watched your last video, Dominique, and that's going to solve everything. And not so much. So pay attention for that too. All right. So what happens here is you go to the bank and you deposit your money. And let's just say, I know they don't do this right now. Maybe they're doing a little bit more of this since it's late 2022. But let's just say they pay you 1% interest, right? Well, what then the bank does is they take somebody that needs a home loan and they charge them 5% interest. And this person pays back 5% interest to the bank. Doesn't matter what amount of money it is. That is inconsequential. So every marginal dollar you put in the bank gets lent out to somebody else, okay? If you don't believe that concept, look up the word fractional reserve banking and you'll totally know what I'm talking about here. But let's just say you're tracking with me. That home loan then becomes a car loan that somebody else needs. Let's say it's person B in this case. And for that car loan, it's 6% interest. Maybe it's a used car, okay? So the bank has taken your $1, paid you 1% on it so far, lent out someone else that needed a mortgage for 5%. And then this second person, they've lent out a car loan and they're charging them 6%. Well, it doesn't stop there. Somebody comes in and says, hey, I need to do a home equity line of credit, right? I'm going to remodel my bathroom, my kitchen, and yada, yada, yada. They're going to charge them 7%, possibly, right? These are just arbitrary numbers. Just keep on going with me. And then somebody's going to come in and say, I need to do a debt consolidation. I got student loans, I got credit card debt, I got hospital bills, all this kind of stuff. And I'm going to do a debt consolidation loan. And the bank's going to charge them, let's say, 12%. So the math that we have here is they paid you 1, and they've charged 4 people 5%, 6%, 7%, and 12%. And if you do the math on that, you might think that it's 26% that the bank has made, but they've made more than that. They've made 26 times what they've paid you, which is 1%, which is 2,600%. I know I'm blowing your mind, possibly. Just go with me. 5% minus 1 is 4. 6% minus 1 is 5. 7% minus 1% is 6. 12% minus 1% is 11. That's how we get 26%. And that may get you to thinking what the bank actually made. But if they made 26 and you made 1, how many times does 1 go into 26? 26 times. So they just made 26% interest off of your deposit. Now, in the last video, I talked about the what if. And the question was, how could you protect yourself from all these different costs? Protect your human value. How could we protect Joe in that example? And the reason you have to think about it this way is because you have to think about how money flows, and you have to think about how the bank is in control of that flow. That is the reason why they make so much money. Their money is constantly in motion. They're constantly in control of the flow of cash. And all we're doing here is saying, well, we need to replace the bank and put ourselves there. And there's a way that you do that. And it's typically through an insurance contract.